Welcome back, everyone, to the latest episode of The Spatial Show. Vlad, good to see you.
Elliot, good to see you as always.
My name is Elliot Golan. I'm one of your co hosts here. And during the day, I am a senior vice president and co lead the real estate practice at Allison, a global marketing, communications, and public relations agency.
And I'm Vladimir Bosanac. I am your other co-host here on the Spatial Show. And by day, the co-founder and publisher of the Registry, a West Coast commercial real estate news website. Elliot?
Today is a very exciting day, my friend.
Oh, how
Unfortunately, a
so?
lot of a lot of negative news we're going to be talking about. So maybe I'm sounding a little like I'm a glutton for punishment, but I love economic discussions. Capital markets and economics is easily my favorite part of this industry, and that's really what we're going to be all about today. So, before we get into that, starting with our interview, in a little while, guests will hear from HomeAbroad CEO Amresh Singh. And what HomeAbroad does is helps foreign investors bring their capital to the U.S. More on the ground level, so obviously not the sovereign wealth funds which have been investing in U.S. real estate forever, but sort of the versions of you and I that may live in Europe, India, China, France, whatever, all the various places. So, very interesting conversation around foreign investment, and we do get into some current events. So, I think the audience will very much enjoy that. Before we get to Amresh, there is a lot to talk about. So, just a preview of what you're going to hear on the Spatial Show today. We have some talks of a lot of capital lettered words. So, the big R, recession, some home builder earnings, and the big F, the Fed. And then finally, we'll close out with everyone's favorite big one, the big S, stagflation. I think if we'll have time, we will try to litter in some good news here. But Vlad, I feel like we're taking the people on a negative journey today.
Yeah, I'm gonna poke a hole in that negative balloon just a little bit with some positive news. Although I think at the end of the day, you and I will still struggle to interpret what that really means
Yeah.
as sort of a bit of a preview. But there is light at the end of this tunnel. I'll just sort of leave it at that for our listeners to be patient.
Yeah. Well, so the first thing we should talk about is the fears of the recession. It's kind of been making the rounds. I think by now most of our audience saw that, JP Morgan's chief economist said in Singapore a couple weeks ago, I think he said 40% chance of recession, and I think that number's actually gone up since then. I believe he was at 50% last I checked, and, you know, this was supposed to be the year where things start to turn better. What was that stupid saying we were all using a couple years back? Survive to 25 or stay alive to 25, whatever the heck it was.
I think the new one is it'll be great in 28.
Okay, I like it. It's a little more realistic. What are you hearing?
Yeah, I mean similar kind of stuff. I think anecdotally, I am definitely hearing that it's going to be sort of more of the same. That seems to be kind of the word on the street from a couple of different people that we've talked to. Now, more of the same, I think, when basically means inflation stays where it is, interest rates kind of stay where they are. That's not necessarily great news for the industry, for the commercial real
Yeah,
estate industry. But I think it's just a sort of new kind of reality that we have to deal with. In our reporting, we have seen a number of interesting kind of things pop up just recently. This is literally like in the last kind of week or so, couple of weeks. There's been some reporting on retail sales kind of not really doing that well. There's been some reporting on small business and consumer optimism continuing to slide. And then there are two national home builders that reported earnings last week, and both of them actually have some subdued kind of results. Given what they're seeing. But let me start with the sort of report on the retail sales.
yeah,
It does. This is coming from Wells Fargo. Based on some of the numbers that they're seeing, a modest gain in retail sales across February, rising just above sort of the zero number, 0.2%.
Yeah.
There is a dip in spending that comes from department stores. There is also a dip in spending coming from kind of bars and restaurants. There are some categories in e-commerce and drug sales that are doing okay, but other categories like electronics, appliance, clothing, auto sales all saw declines in the month of February. Elliot, your thoughts on this?
I mean, to me, that reads, I've said before to folks, I think sometimes the fear of a recession is actually what causes the recession.
Yeah.
And people put their hands back in their pocket. Maybe they don't need to, but they do. And the fear drives them to stop spending. And when we see no money coming into the economy, well, guess what? Yahtzee, recession time. So when I see those categories, the way you're describing them, I think it's a little bit more telling than the numbers because when you look at things like e-commerce, as I assume you are, get more Amazon packages in a week than I can remember. Um, but a lot of that's, like the essentials that I don't want to go out and get, right? Like my daughter's nail polish, right? I don't want to drive to a beauty store anymore. And then drugstore? Well, yeah, prescription medication. If you take that for cholesterol, inflation can, be darned, right? I'm going to get my heart medication, but then you look at things like restaurants and bars, which is the ultimate in discretionary spending. No one needs to ever go to a restaurant or a bar.
Yeah, I think what's interesting here is the sort of overall number going up by 0.2% means it's essentially flat. There is definitely a consumer pullback, just based on the things that we're seeing in terms of consumer optimism. Both, I believe, the Michigan study and the Wells Fargo one. There was a second one. Both indicated that we're seeing people starting to pull back in their spending. There was one anecdote that I also heard. People feel very good when their 401ks are doing really, really well.
Sure.
And it usually leads to increase in retail spending and just kind of things like that. But the same is true for the inverse of that, which is when people see their 401ks not doing that well, that they will likewise pull back. And I think that's what's happening. I mean, the market has been down over the last couple of months, impacted by some of the news going on in our country and also across across the world, and I think we're starting to see this impact essentially the flow of money. Now, does that mean recession? I don't know. That's probably going to be something we're going to look back probably 2-3 months from now to kind of understand where we were in the February-March time frame, right? But that's where things seem to be going.
Yeah, it's interesting because I do think what we have is this strange, I'll call it kicking of the can, where I think whenever there's a new administration, regardless of anyone's opinion on a particular administration, there's always a bit of uncertainty, especially if it's a changing of parties, going from right to left or left to right, doesn't matter. There's always this bit of, all right, well, let's see what they're going to do. Well, and everyone kind of hits pause. And I think we were all talking about that pause as being kind of, what it's supposed to be, relatively short. And that pause seems to just be kind of bleeding on like the third act of a Shakespeare play. Like it just won't end.
Yeah, although we had a bump right after the election, right? The stock market sort of roared back,
Right.
if you will, kind of towards the end of the year. And then I think with some of the new announcements around the trade policy and all these other
Right.
spending cuts that have been announced. I mean, there's definitely been an impact. Interesting, like I mentioned, the two home builders, so Lennar and KB Home, their stocks tumbled over the last couple of days, and both because basically in what they're anticipating. So Lennar's stock tumbled even after their numbers beat analysts' kind of expectations.
Wow.
But the worry was that going forward, the company was anticipating, and they sort of announced this, that the buyer will not have sort of the buying power, right?
Yep.
in the second half of the year, and they're really concerned about sort of what that means. KB Home, similarly, their earnings per share fell year over year, so they did not beat analysts' figures. They actually delivered fewer homes, about 9% fewer homes than they did in the same period last year. And during the call, one of their executives basically said that they've had to cut pricing in a lot of their markets, and some of these price cuts ranged anywhere from $5,000 to $30,000. Now, they
Oh,
did
wow.
highlight that Florida was probably one of their softest markets, whereas the Western markets did relatively well. They didn't have to cut
Makes
as
sense.
much in some of the Western markets. That could be, oversupply, but it also shows sort of where perhaps the economic growth is, starting to, or lack of economic growth is starting to
Right.
kind of rear its ugly head, right?
Yeah, and I mean, home building and residential is a huge, part of the total economy. And
Yep.
when you talk about economic growth, it's about, I think we're about a week out now from the latest Fed meeting, and I don't want to say it was negative, but it was a pretty tempered meeting as well, right? Everyone kind of has this, we're not really sure, things aren't looking great. So, they're obviously they held rates, which very few people are surprised by. But they are predicting slower economic growth and higher
Yep.
core inflation.
Yep.
And I think there's been a lot of reporting. I think you even told me about it, about just capital moving from the U.S. to Europe.
Yeah, there's been some reports that there's been quite a bit of decrease of investments, or the institutional figures have decreased in the U.S. Now they have not moved to Europe one for one,
Right, right.
but there's been an increase in the number, not in the number, but in the sort of levels of investments into European equities. Now, one of the reasons that has also been the anticipation of, I think, increased spending in defense budgets there. So I
Yeah.
think that is one of the reasons. But this anecdote that I heard also said this was like the highest number in like maybe 20 years that this has happened. So I think it's kind of signaling maybe a shift. I think
Yeah.
it's too early to tell maybe what all this means. But all this to say is that there are a number of different sort of indicators, tied to consumer spending. And let's face it, 60, 70% of the US economy is consumer spending, right?
Right.
If we have consumer optimism declining, if we have small business optimism declining, if the sort of purchase power of the consumer is getting reduced, if they can't afford homes, if the interest rates are going to continue to be high, I don't think this really spells great news for the real estate industry over the next 12, 18 months, maybe 24 months.
Yeah, I mean, those aren't inspiring figures. It's kind of those things where real estate is, at some level, a barometer of the broader economy, right? If the economy is doing poorly, real estate doesn't sort of upend that and do well. Like that just doesn't happen. That's not a real situation. So further on what you're talking about, I found a very interesting stat. That was one of those very rare times where I got this sort of like draw drop action. B of A did a survey. It was 171 investors overseeing more than $425 billion in assets. So they've got a few quarters in the couch cushions. And apparently, among these people, 71% of them said they expected stagflation to hit the global economy over the next 12 months. Not 10%, not 20, 71%. That's big, man.
That's a big number. I remember at business school when I did a decision sciences class. Perfect sort of lack of knowledge or lack of understanding is 50%. That means it can go either way. You
Right.
don't know
Right.
which side is going to win, right? If you have 70% showing in one direction, that means you have some information to really believe that it's going in that particular area. I'm curious sort of what that means globally and kind of in their analysis, like how do they take account of the top 10 economies in the world, right?
Right.
Like,
Right.
are they measuring everybody, or are they measuring sort of a certain, the most important economies? That we don't know, right? Or I don't know. At
Yeah.
least maybe they mentioned it,
It might
but that
be.
would be one way to sort of understand that. It is interesting, because I think the global economy, as it may act the way it does. That doesn't necessarily mean that some of those big movements are technically going to impact, let's say, a
Right.
specific market in a specific region. So let's say commercial real estate on the West Coast may do fine, right? Midwest or whatever, but it doesn't spell good stuff across the board, especially if
Right.
the more we are connected as a globe, if you will, economically, right?
Yeah, and it's always going to be the broader overlook of things, right? I mean, when we talk about rent growth being flat or rent growth being up, I mean, if you're in Los Angeles, you haven't had flat rent growth since the 80s. It's always going up. It doesn't matter what the economy
Right.
is like. So we're looking at things holistically, right? So obviously Tuscaloosa, Alabama is going to buoy what you see up in the Bay Area. That's just the economy. But what this leads to is, and I sort of talked about this at the top here, and I want to get into it a little bit. The big S, man, stagflation. That is, by my estimation, and I've spoken to 3 different real estate people in the last 3 days on this. Senior executives, chief economists, not random brokers, and it is the one thing that no one sees upside in.
Right.
Delinquencies, people losing their jeans, that just means the institutions come in and buy things for nickels. That's fine. There's always opportunity. Stagflation could be the only time where no one is happy. It's
And and their
and
estimation was that
good
there's
chance.
some warning signs.
Yeah, there's good chance. There's fear. I mean, broadly speaking, stagflation has 3 major buckets that
Yep.
suggest we're in that situation. One is high inflation. Okay, check. And if we listened to the Fed last week, in fact, we're expecting it to sort of grow as opposed to shrink.
Right.
Slow economic growth.
We got that.
We got that. And the Fed, again, last week predicted slower economic growth. So we're 2 for 3 here already, right? And then the last is high unemployment. And we are
Yeah.
not at that situation. That's sort of the last shoe to drop. If we do see unemployment grow, then I think I mean, that's it. You're batting 3 for 3.
Yeah.
We're there.
And what's interesting about unemployment is that will be driven by consumer spending. That will be driven by the
Right.
pullback in all these sort of retail sales and just spending overall. And so it could have a lag effect, right? Where this maybe happens in the second half of the year or maybe first half of next year, right? When we start to realize some of these unemployment numbers. And so this stagflation could does that mean maybe it's a sort of thing that happens in 26? That'll be interesting. That'll be very interesting. I
Yeah.
think a lot more things will be clear in 26 in terms of some of the macroeconomic policy as well. And
Yeah.
so, I'm curious, obviously, for both yours and my sake, to see how this plays out.
Yeah, and I mean, that's the thing about when you have those first two, the inflation and the slow economic growth, those are very complicated. Unemployment, sure, everything is complicated. I'm not trying to completely minimize it. But when the economy is bad, unemployment goes up. I mean, I hate to be so simplistic here, but unemployment is never good during recessions. Like we can draw some very sort of left to right lines that are not complicated, right?
Right.
During recessions, hiring doesn't go up. That's just not a
Right.
thing.
Right.
So if we're headed for a recession, high unemployment just follows. It's the coattails.
That's right. That's exactly
You
right.
know,
Yeah. Yeah.
so that's and then it gives you a chance. And I have to, before we get on to some positive news here, we'll end with the biggest downer of this whole topic, which is my time in business school. My favorite phrase, and I'm sure you've heard it, the misery index. Uh, for those that
Right.
don't know the misery index,
We're hitting all the
Um,
hits here,
yeah,
all the positive hits today, Elliot.
yeah. I can't remember. I'm gonna butcher this here, but it was maybe an Australian economist. I think some economist coined this term, the misery index, and ostensibly what it is kind of an overall look of how people are doing, generally speaking, financially. So a broad overlook, like how miserable are you? And at some level, inflation and high unemployment will have a positive, negative, depending on how you look at it, because we're increasing misery, which is a negative here.
Right.
Um, and the misery index is on the rise. So I thought, I'd put a little bow tie here on our ray of sunshine related to the economy with my favorite phrase from business school.
Yeah. So, quick search, Elliot, while you were talking about that. So, Arthur Oken is the. I hope I hope I'm pronouncing his last name. He was a professor at Yale, I believe it says
Okay.
here. Graduated from Columbia College back in '49, and he is the founder of
Okay.
the Misery Index. So
The
anyway,
misery index.
yeah. So that is not that is not a positive thing to call back out.
Yeah.
I don't think anyone will be happy to sort of see that now we're measuring that. That's kind of a thing again, right?
Right, and that's kind of the biggest thing here, and we'll move on. I think the biggest thing here is, when was the last time you even heard the misery index and stagflation in the same sort of 25-minute period?
Yeah.
I can't remember.
Are we breaking ground here with our podcast here, Elliot? Is that what you're saying?
Other than being trendsetters here, I think this shows the sort of drama of our situation.
Yeah.
The last time, and most famously, the stagflation era from the oil issues in the late 60s and early 70s. We've had good times and bad times, but I can't recall a time where stagflation was a topic in headlines and the misery index was back from the annals of business textbooks.
Yeah, I think you're right. The last time I think this country saw it was in the early '70s during the kind of oil crisis that we experienced. So
Yep.
that was a really different time in so many ways, that I can't even try to compare it to today's economy. But it does portend for the next foreseeable future, 18, 24, 36 months, that it seems if this is the direction that we're heading, more of the
Yeah.
same, if you will, that means we're probably going to continue going through some of the very similar things that we've reported on over the last sort of 6, 18 months or so into the next 6, 18 months, which means probably, debt will be difficult to get. Interest rates are going to be higher. You're going to
Yep.
have, valuation of commercial real estate sort of continuing to be, challenged, right? That will impact obviously what it means for, tax revenues, right? For different
Of course.
municipalities and, states and counties, all that kind of stuff. So it's going to be an interesting time, I think, right? But with all that, the one kind of positive piece of
Yeah.
news, because we wanted to end this conversation on something positive. So this bit caught my eye. So there was a report from Commercial Edge, and this is a company owned by Yardi, I believe, and they've
I
been
think so.
pretty
Yeah.
good in most of their reporting. They do kind of broad sort of national kind of averages. They look at all kinds of different things. Some useful, some not so useful in certain
Sure.
cases. But in this case, they did a report on co-working space. And co-working space, I think you and I, when we talked about this a little bit earlier this week, we sort of felt like co-working space was kind of one of these trends that kind of came and was hip for a while and kind of went away. But year over year, based on their reporting, it's gone up 25%, which is really significant. I
Yeah.
haven't heard of any kind of food group in the commercial real estate industry that's increased anything 25% in the last 12 months.
No way.
And
Not even
so
close.
It is interesting. This is a national average. We've done reporting on some of the West Coast markets that they follow, and certainly on the West Coast markets that we track, this has been the case. And so it says a few things about where the industry is going. But I'd like to just hear, your thoughts on sort of your initial feelings about this, this expansion.
I'm very curious how the figures and the definitions are sort of being enunciated here, if you will. But I find it very interesting because I feel like co-working is like a lot of things we've had in real estate. It had its 15 minutes, to use the Hollywood term, and it didn't go away. It just, it was, everyone said, and I remember I was a reporter during co-working's huge rise, covered WeWork, and the thought that it was going to take over a commercial office, that Kilroy Realty, Brookfield, y'all better watch your back. It's over. That was just that was never real. And those of us in the industry knew that was kind of just platitudes. So it kind of shrank back to where it belongs, right? I mean, if you go back to 1985, you could get a single desk at a Regus and you could call it co-working, right, with a shared secretary.
Right.
So to see that it's still rising at this rate is interesting because it suggests that we're not up with our 15 minutes.
Well, what's interesting about that also is the shrinkage that you explain. Like, I wonder if that is just because of WeWork. I mean, WeWork as a
Sure.
business has gone out of business. I mean, it's still in business, but it's a much
Yeah.
smaller portion of what it used to be. What this also tells me, I think it's interesting, is that companies are basically, and this goes back to kind of support the negative points I think that we were highlighting in the earlier part of the show, which means if this business is growing, this means companies are not necessarily enthusiastically embracing, corporate leasing, right?
Right.
And maybe what
Right.
they're trying to say is, hey, let's do this slowly. Let's kind of get some space. Let's rent some kind of flexible space, or let's give ourselves the option at least, right? Because we don't know where our company is going and what it's going to mean. Let's not sign a 5-year lease or a 10-year lease because I don't know what's going to happen
Right.
6 months from now, right? Let's just go
Right.
into a WeWork or an Industrious or the myriad of other local, regional, and national sort of players, right? And so
Yeah.
that to me is very interesting. I think it's telling a story that certainly the industry is not necessarily ready to be kind of back,
Yeah.
even though in certain markets we have seen corporate leasing go up. There has been some positive news coming out of certain markets. But overall, the fact that this continues to grow leads me to believe that we are definitely not out of the woods.
Yeah. Yeah. I mean, in 2020 and 2021, the buzz phrase was hub and spoke. I'm sure you remember everyone talking about that was the
Yeah.
future of office, right? You weren't going to have a 200,000 square foot multi-floor, everyone in the same place, but you were going to have a couple of Class B suburban office buildings for all the executives, and then the young kids who want to live in the city, they go to a WeWork or an Industrious, and everyone kind of gets their own office. Now, of course, that was never going to, pan out, and it hasn't by and large. But this suggests that there's a desire by the employees to be in the office. And I'm not one to typically say this as someone who's been remote for like 95% of my professional career. Um, Co-working and those types of spaces are usually stuff that the employees are more interested in than the landlords because of the flexibility, because of the proximity. You don't have to typically, you don't drive to a place, 45 minutes away on the freeway and pay $25 a day for parking, right? It's a little bit different of a vibe that I think dictates or speaks to, I should say, kind of the employee demographic versus the executive demographic.
So the landlord perspective on this is actually quite interesting because over the last, I don't know, 6 months, 12 months, there have been a couple of landlords, more than a couple, maybe a handful, at least a handful that I'm aware of, that have opened up these plug and play suites or offices. And what they've done is sort of taken, vacant stuff and created something that's ready to go. Where companies don't have to worry about, TIs, don't have to worry about design, picking furniture. It's already picked out for them. The landlord is upfront invested, I don't know, a couple $1,000,000 to sort of outfit the
Right.
spot, and it's ready to go. I wonder if, and I don't know. I may need to go and ask Commercial Edge to see if they'll share kind of how they got this. But I am wondering if some of the increase is due to these landlords kind of taking some of the space off
Right.
and creating these little incubators, if you will. And this is not just an office thing. Certainly, in the office side, I have seen a couple of development firms, even just here in the Northern California region where I am, but also on the life science side, up in your market
Right.
in Seattle, I'm aware of both Biomed Realty and Lincoln Property in partnership with Intercontinental have
Yep.
created kind of a little, they call it incubator, but it's essentially a pre-made lab office ready to go. So when a company has an idea or just raise some cash, instead of having to now engage a broker and look for something, they have space ready to go.
Yeah.
And look, look, if I was about to lease some space and my CFO was giving me an option to sign a 5-year or 10-year lease, I would probably ask him, is there anything shorter? Do we
Yeah.
have to commit for this amount of time? I don't know what's going to happen in 10 years, 5 years. How about we just go something that's flexible, right? Or hey, I've got half of my workforce on the other side of the region. Why not just rent them some space so they're not commuting 3 hours into where I am, but they're still going to be at the office, right?
Right.
And that's another thing. And so I think these are some things that are very interesting. And I think the fact that co-working is not going away. In many cases, it seems like it's actually growing. I do wonder if its golden hour is just approaching. Right, we haven't even sort of hit the kind of 15 minutes that you referenced. Right, maybe
Yeah.
it's now rising. Right.
And I think you might be onto something about almost, let's call it a institutionalization of the co-working industry. So obviously we work IWG, some of these brands, they were large valuation. Well, not were. IWG is still the 800-pound gorilla, but valuations were huge. Backing was great. They had all the money in the world,
Yeah.
but they still had kind of this hip and loose kind of energy to them. That was the whole point of co-working. So now I'm wondering, when I say institutionalization, I'm thinking more about those spec suites you're describing, right? You go into a Blackstone owned office building, right? Columbia Trust owned office building, and they have something akin to a
Right.
co-working space,
Right.
but they're still a old school big landlord. So I'm wondering if that is representing a lot of what we're talking about and if that's the next phase for the co-working industry.
Yes. And wasn't it also announced just earlier this year that CBRE was acquiring Industrious?
Right.
Right. I think for obvious reasons, I think they're probably seeing demand in this space grow, and they want to be able to offer another service to their landlords, their clients, right? And even sort of a platform for tenants to kind of put them in a place and then help them grow into something that's more permanent, right?
Sure.
So I don't think these are accidental. And anyway, it's one sort of important part of the commercial space that I think has a positive sort of outcome in the first few months here in 2025, and I'm curious to see what happens for the rest of the year.
It's going to be very interesting. It's going to be very interesting also how it all relates to kind of these economic headwinds we're
Right.
discussing. Um, well, I think that's. I think we'll wrap this thing up. So, as a reminder, all of you are about to hear from Home Abroad CEO Amresh Singh for a very interesting conversation on foreign investment in U.S. real estate. And we even touch on the administration and some of the sort of confidence or questions that may be coming from other parts of the world related towards U.S. investment and U.S. policies. So I think it's going to be a very valuable conversation. Vlad, always a pleasure.
Elliot, great to see you again. We'll see you again next week.
All right, man. Take care. Hello, hello. Welcome to the Spatial Show. Today I have with me Amresh Singh, CEO of Home Abroad. How are you today, my man?
Hey, Elliot, I'm doing great. Thanks for having me.
Yeah. Well, before we get into kind of the meat of our conversation here, kind of give me the nickel tour of who you are and what Home Abroad is.
Awesome. So I'm Amresh Singh. I'm founder and CEO of HomeAbroad. My background is really in mortgage finance and real estate tech. Around 10 years ago, I relocated from India to the US to work for a multinational bank. And as part of that journey, both from my personal experience as a global person coming into the US, as well as working for this international bank, I realized there's a gap in the market for international customers purchasing US real estate. I will talk about later in a podcast why US real estate investment is so much attractive for global buyers. But saw that gap, and the foundation of Home Abroad was built. At Home Abroad, we address those challenges and issues for global investors investing into US real estate. We are one-stop shop helping global investors to find the right investment property, to offering specialized mortgage solutions without needing any US credit history, which is a big blocker, right?
Yeah.
Without needing US residency or visa, right? To help them with mortgage financing with up to 75% leverage, right? Which is a big thing. We help them connect with local real estate agents who are experts in working with international buyers, property management connections, help them with US bank accounts, LLC setup, and much more, right? So everything in between and beyond to really facilitate US real estate investment from global investors is pretty much what we do at Home Abroad.
I think I read an article just this week about how foreign investment in real estate was expected to pick up. But so
Yep.
all across our conversation, it's kind of
Hmm.
I feel like it's trend day, but they're often misunderstood. There's these buzzwords all over the industry that people just throw out. They have no idea what the heck it means. It's
Hmm.
just cool.
Hmm.
It's what all the cool kids are saying.
Yeah.
So we'll touch AI, we'll touch disruption, democratization, which is another one of those kind of
Hmm.
vogue things. But I
Hmm.
want to start with the model because on the face, foreign investment in US real estate, that's really old news. I mean, it's long been viewed as a safe haven for capital. That's like that phrase is nothing I've invented. It's been said by everyone. Um, so, what's your advancement or wrinkle on that? How is what you're doing different than, well, I mean, Asian and Middle Eastern investors are buying trophy assets all over the country?
Yes, you're right, Elliot. The US real estate investment by foreign nationals is nothing new. US has, long been viewed as a safe haven for investment, especially with the USD being the reserve currency of the world, shields you from currency risk, right? So it's nothing new, but it's also very old school. Most of the investment from foreign investors are restricted to folks who already know that this is a good thing, right? So either you had some US connection, right? You had friend and family in the US, you worked here for some time, you know that US real estate is probably one of the few markets in the world where you can generate positive cash flow with leverage, right? But this knowledge is not common knowledge. This is not that everyone knows about it, right? Uh, Still most of these buyers are cash buyers. They are buying these properties in cash, right? Because they don't know that financing exists. So what Home Abroad, what we are doing is really reimagining the way foreign investors are investing into US real estate, right? First and foremost thing is financing, right? So as I mentioned, I want to touch on this a little bit because we in the US we don't realize this, right? But US real estate market is one of the few markets in the world where you can generate cash flow with leverage. And what that means, right? Because devil lies in detail over here, right? What that means is, you have high rental yields in the US. So typical, if you buy in the good market, your average rental yield is between 8 to 10%, right? You have 30-year fixed rate mortgages, right? Now that's not available or very common, in other places around the world, right? When you combine high rental yields and 30-year fixed rate mortgages, you are looking at a wealth building machine. Now, how that works, is you buy real estate with leverage. So either 20% or 25% down, depending upon whether you're a US national or foreign national, right? That 25% of your money helps you buy 100% of the property, right? And because of high rental yield and your mortgage payment amortized over 30-year period, you know, rent covers mortgage and
Right.
helps you generate cash flow, right? So my 25% of my investment as a foreign national, or 25% of money bought me the 100% of the property, and my property is paying for itself from day one, plus generating me a passive income. Now, what I just did is I created an investment asset where it generates me passive income with leverage. That is very, very, very unique, right? That doesn't exist in most places around the world where you are buying or investing into real estate mostly in cash and looking at, capital appreciation through property
Right.
appreciation, right?
Right.
So, this is a very unique concept, right? Doesn't exist around the world. So when you make mortgage financing available, right, it changes dynamics. Now it suddenly, makes this investment open to lot many people and gives them access to an investment asset that is not available in their part of the world, right? You are tapping into again the same old value prop that you mentioned
Right.
earlier, right? You're tapping into the safe haven with the on US economy being the largest economy in the world, US currency, being the, shielding yourself from currency risk. Interestingly, I was looking at this data this morning itself, where in last year, US currency is up 7.5%, whereas most currencies around the world are actually down, right? So just by putting your money in US dollars and getting appreciation in US dollars, you're kind of, magnifying your returns, right?
Yeah.
And
Yeah.
that is what appeals, to foreign investors so much. And that's the advancement we are doing, making mortgages or leverage available to the foreign nationals. Second, most people are, earlier when they used to invest, or like foreign nationals who knew about it, they were investing around places they knew or their family lived. And most of our investors used to come to us and say, hey, this sounds like a great idea, but I don't know US. I don't know the markets there. You tell me where to invest, right? And we were kind of going into, Zillow, and we were doing investment analysis for our customers, letting them know, hey, this is a good investment, right? And then we were like, wait a minute, let's just build this tech platform, right? Where if I am a global investor, I can come in, I can tap, what's my investment objective, right? Is it to generate a cash flow, certain return on my cash invested? Whatever is your investment objective, you tap that, you put basic attributes. What's important to you? I want to buy investment property in area with job growth, population growth, whatnot. Build an AI wrapper around it, so it is more personalized to you,
Right.
right?
Right.
And bingo, with few clicks, now you are able to see, not only find the right investment property that meets your investment objectives, but you're cutting short your hours and hours of research into those few clicks, and you know exactly which property to invest in. So the decision making time period suddenly goes from months to few days, because you're
Right.
making the data driven informed decision on what property will give you meet that investment objective you're looking for. So these are the things which we are doing, Elliot, from the advancement standpoint, to really streamline the process, really make it more accessible to global investors in investing into US real estate. If that help answers your question.
Yeah. So talk to me a little bit about your investors.
Mhm.
Obviously they're varied, but what's your typical profile look like? Is it a mid-career professional with discretionary income? Is it a independently wealthy person that's looking more at generational growth, small companies? What's kind of the rough profile? And do you find certain hotspots globally in terms of where these investors are coming from? Because in the commercial space, and I'd love to know what asset class as well, if it's all
Mhm.
residential or if these people are looking at commercial as well. In the commercial space, there's very specific regions that typically have a large swath of the investment dollars coming from overseas.
Yeah, that's a great question, right? So, good thing is, what we have seen, it's kind of across the spectrum, right? So we see value investors, like a lot of Canadians who want to buy property in Cleveland area or Midwest US, where they're trying to buy, properties for $100,000, $120,000, like between I'd say 100 to $200,000, where they see value for money, right? The taxes are low, house prices are low. Canadians are used to seeing property prices in, close to a million versus, when they see properties in Cleveland area, Ohio, in that dollar range, they're very attracted. The rental yield is great, right? So we have that spectrum of customers who are looking to really value turnkey properties, that gives them that immediate return. And we have investors who are looking to buy, $1 million mansion in Miami, right? We have, international students coming into the US, right? So their parents are thinking ahead and they're like, okay, let's buy an investment property in that area. So, I can generate some rental income, right? But also as the property appreciates in US dollars, I can either cover or offset a mid chunk of that tuition fee, right? So I would say, we have kind of different variety of personas
Mm-hmm.
among this, for global investor group who are looking to either invest at all price ranges. Like we did a recent transaction for a UK client who bought an investment property in Miami for $3 million, right? And we closed another loan, for $75,000, right? So
Right.
the reason I want to bring these examples is, it's across the spectrum. It's not a one use case. It's a variety of clients, who have this persona. But one thing I'll tell you that is common among these clients is they're not buying one investment property, right? It's mostly, okay, I'm going to test the waters first, right? But it turns into this wealth building machine, right? Because my first property is paying for itself, right? Because rent covers mortgage, it's giving me the cash flow. Wait for 2 3 years, property appreciates in value. You do a cash out refinance, take the cash from the property, use that money as down payment on another property, right? Now that property pays for itself, right? And the cycle repeats, right? So they are kind of, using this as a wealth creation tool, right? Whether you start small or big, at some point, get to that level, right? So I would say it's kind of all over the place. In terms of the hotspot, of course, Canada is a big market. A lot of Canadians investing into the US real estate.
Yep.
We see a lot of interest from South America as well, mostly in Florida, Texas area. A lot of European clients buying into as well. India has been a recent, shift as well. But the what opportunity we are finding, Elliot, is the knowledge gap, right? Because people who are coming to us today know about this, right?
Right.
There's actually a much bigger underserved market who don't know that they can invest in US real estate, why they should invest in US real estate, and that financing or leverage is available for them to invest in US real estate. So
Right.
the market is actually much bigger, and we are actually trying to increase the market size through knowledge and education.
So I have to ask because it's basically every news organization is covering nothing but immigration and new
Hmm.
administration policies. Are
Hmm.
you receiving questions? I'm not suggesting that your investors are running away or anything, but do you field questions that say, "Hey, Amresh, like, am I going to be able to do this in 6 months, or am I going to be able to do this in a year? Are any of these policies potentially altering strategy?"
Absolutely. It is, when things are in the news, right? For example, I'll give you a recent example from Canada, right? When the current administration imposed tariffs on Canada, we
Right.
had active Canadian clients who were in discussion with us who were like, I'm not sure anymore, where this is going to go, right? Because one was more of, the national sentiment. Okay, do I really want to go ahead with investment into US with everything going on, right? But what tends to happen earlier, the fundamentals remain strong. The why of investing into US real estate remains strong, right? And and real estate is a long-term game. The
Right.
administration changes, the short-term policy changes, it's all short terms, right? But real estate, are long-term game, right? So when you have that informed conversation with the clients, yes, there are things in the news, right? But the fundamentals of US real estate are not going to change. The fact, the rental yields, the robustness of the US real estate market, the robustness of dollar is not going to change. And it's a long-term game, right? So when you kind of put that into perspective with short-term policy changes, short-term administration changes, right, versus long-term why US real estate, it puts things into perspective. And we have clients, who were hesitant at first, but keeping in mind the long-term
Right.
aspect of the real estate play, they still went ahead with the transaction. They are, actually, we've just closed a Canadian deal from the same client who was hesitant, within 25 days of them putting the file with us, right? So, you know, to kind of sum it up, you know, in the long term, it doesn't really matter, right? So yes,
Right.
we'll have those short-term hiccups, but we try to educate our clients, on what our perspective is, and really, it shouldn't matter if you're looking at it from a long-term investment standpoint.
Right. I mean, that makes sense. Even flippers, which I don't assume a lot
Hmm.
of your clients are, because that's a very domestic business.
Yeah. Yep.
Um, it takes time. Speaking of
Hmm.
of domestic, so we were talking offline, and I'm very curious about sort of your plans to kind of broaden the scope of the company. Right now, you describe the company as a vehicle for foreign investors, but that's changing.
Hmm. So, great question, Elliot, and appreciate you bringing this up, right? So, when we build this AI-powered investment property search tool, right, which is practically going to be the Zillow for investment properties, right?
Right.
We thought, nothing like this exists in the US domestic market as well, right? If I am an American trying to find an investment property, there's no place for me to go and start. And that's reflective in the numbers too. Only 7% of Americans own investment properties, right? And we just talked about the wealth building cycle of US real estate. If foreign
Right.
investors who are not living and working in the US, they are trying to invest in US real estate because it makes sense. It's a wealth building tool. Rent covers mortgage. Your property practically pays for itself. It appreciates. You can do a cash out, do the same thing, kind of create this generational wealth through this cycle, right? Why are only 7% Americans doing this? Right? Because there's a lot of inertia initially. You think, do I really want to get into hassle of property management, or like
Right.
be a landlord, manage rent, whatnot? There's a lot of initial inertia, and a lot of that is also people don't know about, that the financing is available with specialized for real estate investors. They're thinking, oh, I'm already paying a mortgage, I will not qualify for a second mortgage on my investment property, not knowing that there are specialized mortgage products which underwrites then the loan based on the rental income of the property versus their personal income or assets. So we don't care what your debt to income ratio is. Till the property
Right.
has the merit to pay for its own mortgage, you are good. So it's a win-win situation. You are buying a property that, as a lender, we are kind of ensuring you, yes, this property makes sense for you, right? Because we are underwriting on rent covering mortgage. So the fact that we are taking that risk and providing you 80% financing if you are a US based investor, right? And you have 20% skin in the game, you are kind of assured that, on a conservative basis, the rent is going to cover mortgage. The market rent is probably going to be higher, right? So it should make sense, but people don't know that a product like this exists, right? So with that value prop, Elliot, the natural thing for us was the product remains the same, the mortgage solution, right? The investment property search vehicle is nothing like that exists in the US market as well. There are paid subscription based solutions where you can go and analyze your certain property, but there's no open ended platform where you can put attributes on what matters most to you in terms of,
Right.
okay, cash flow is important to me, or rental yield, or whatnot. You hit search and it gives you the properties that match your investment objective, right? So with that, it was natural for us to say this is a problem in the US market as well. not 7% Americans holding investment property. This number could be much higher, right? And we want to increase that penetration. So we see this as a big opportunity for us to enter into the domestic US market as well, because the key value props that we are doing for global investors remain the same, right? And with this AI driven approach, they're going to have a personalization around what you want as an investor, and see that those right properties that fit your investor persona, right? So it just made sense for us, and something that we want to launch sometime in March is what we are working towards Elliot right now.
Oh yeah, so any day now, I suppose. So
Absolutely. Yeah, we're going into beta testing right now, so any day.
so talk to me a little bit more without getting too deep into the technology. I don't think my audience is up on that, but AI in real estate is kind of this thing that like I said at the top here, I don't really think
Mm-hmm.
people understand. Everyone says we're leveraging AI, and yeah, maybe in a very sort of rudimentary sense, the way you probably were years ago and just didn't comprehend that it was artificial intelligence. So, talk to me a
Mm-hmm.
little bit about the novelty here. What's special?
So I think, if you think about it in a very layman term, right? Artificial intelligence is nothing, but it's trying to personalize, and make things more transparent for you, right? Without you being, you know, doing a lot of fancy stuff on your end. So you ask a question, right? Your question is translated into, whatever algorithm that mines the data for in the background to give you the right answer, right? That's the very basic, from a basic, very crude sense, that's what it is, right? So from our perspective, it's about how do I personalize the information to our clients, that makes them, helps them make the most data-driven decision to do the right thing, right? It's the way we look at it, right? And I believe, real estate industry as a whole, has been very resistant to change overall, right? We don't really, embrace change. It takes a lot of time for us to embrace change, right? But AI is where, like if you look at recent data, even like search engines are losing traffic to AI models now, right? People are going on ChatGPT to kind of, do their query versus on search engines, right? So it's gonna happen, right? We are at the BlackBerry moment, in real estate right now, right?
Yeah,
That's just the way I put it, right? Either you think we are irreplaceable, this is what customers want, and resist change, or really adopt that change into everything that you are doing, right? Because it is going to make things more easier, efficient, and practical for you and your clients, right? So the more you embrace it, the better is going to be, for you as a business and for your clients. So we are practically, embracing AI not only in customer facing things, Elliot, but also in a back end, processes and things that we do, right? We build this entire for our foreign national clients, we build this entire chat engine, through open source and AI model where uh, my loan officers today can chat with any customer around the world on their device in their language in real time,
right.
right? And that is so much efficient. Our entire processing infrastructure uses AI to, make things efficient for us to close loans faster, right? So we are kind of, of course, our property search platform uses AI to really personalize choices for our customers. So a customer can say, show me properties in this area with certain with at least $500 cash flow, with job growth, population growth, landlord friendly laws, and you punch that into our AI, and we will kind of curate, mine the data in the back end and show you the relevant properties that match those criteria, right? That's pretty much what it is. You are making it easy for the customers to query what they want, and we are kind of using those language models in the back end to give you your search intent, right? Is what we're trying to do. So really the core of it is embracing this new technology, right, to make things easy and faster and efficient for your customer base. It's really the heart of what we are doing today too.
So you said a phrase that really jumps out and sort of catches my my ear, if you will. And it's kind of our last buzzword that I want to close on here today. You said open source, and I've been in real estate a long time. It is the epitome of a transaction based business. Sure, relationships matter, but the relationships
Yeah.
are to get somewhere, right? I mean, this is the ultimate transaction based business, and you're taking a different approach. You're saying,
Hmm.
here's all the information. Why?
Hmm. The simple answer, it makes sense. The more, you can, and again, I'll use another buzzword over here, democratize the information, right? Better it is for everyone involved in the process, right? Because ultimately, as a company, we're trying to make things simple for our customers. We're trying to make things efficient. That's the only way to grow. You can add all the buzzword AI, open source, on top of it, but at the very heart of it, it's how do I make things simple and efficient for our customers, right? And and if you kind of approach your business, approach your customer interactions with that mentality, it just becomes easier and there to embrace what's coming, because that's what it is supposed to do. All the new advancement that's coming in, either AI or open source technologies that you can leverage in your processes, at the heart of it, it's making things simple, easier, efficient, right? And this is what as every business should be thinking from that perspective. It's not about those buzzwords. It's not about something fancy. It's about, can this solve technology that exists today, which was not available to me, is helping me to take that next step, and is helping to make things easier for my customer, is making things more efficient for my team, and can I do things in a better way, right? If you kind of approach with that mentality, with that mindset, you'll certainly find yourself more open to these changes and embrace these changes, use this into your day-to-day process in a much more efficient way. So that's the answer for a why. I know it was a pretty long answer to your
Yeah.
simple, question, but that's the heart of it, Elliot. It just makes sense.
Well, real estate has this bad habit of doing kind of technology for technology's sake just so we can tell people we're, hashtag data driven and all this, things. So
Yeah,
it's very,
yeah.
it's refreshing and sometimes unique to see technology that's actually not just talked about, but implemented and
Hmm.
implemented to the benefit. So I look
Yeah.
forward to hearing more about this product domestically as it rolls out. But thanks so much for your time, Amresh. It was great talking to you.
Thanks for having me, Elliot. Great discussion, great questions. Love it.
Talk soon.
Take care.